Hello traders, hello everyone. Welcome here at Life Education with XM. We are starting together with Rafi. Here with me, we are starting trader versus analyst session about fundamental background of current market action and what does it mean for us traders. Hello Rafi, how are you doing? How is it going for you? How
Hello,
it's been this
Harsin.
week?
Yeah, it's been a fairly quiet week. Hopefully it's going to get a little bit more exciting in the next 30 minutes. So I think it's going to be a pretty interesting session today because, of course, uh, the ongoing speculation is the Fed or can the Fed go 50? That's really what's driving the markets. Really, nothing much else matters. It has to be said. That's pretty much where things stand at the moment.
Well, yeah, actually, so it's been like you would like to say a calm week, or I would like to say it's been a calm week, but at the same time, things been happening in the background, and I feel like there is a lot to ask you about, like to kind of catch up with how the sentiment is developing, because actually it's been quite interesting to see markets like markets like last Friday, last Saturday, they got Jerome Powell confirming, and not only Jerome Powell, because other FOMC members were kind of hitting the same tones, the same notes about being ready to start cutting interest rates. And so, interestingly, the market took it very much against the dollar, but it's not unexpected, right? So what actually happened was that markets were thinking about 2 or 3 rate cuts this till the end of this year. That's been priced by the futures rates pricing, and then out of a out of a sudden, like Powell just says that, and markets go boom against the dollar even more. So it's been the fact that market actually continued selling, and then out of a sudden this week we are seeing pricing of like 4, maybe 5 rate cuts this year, which is in my understanding, it's a little bit excessive. It's like moving ahead of oneself. So I was being curious what's going on, and maybe the fact that it was quite it was not very highlighted, but Atlanta Fed GDP Now model dropped also to 2% GDP. So there's been this concern maybe underlying that uh, it's not only it's not only that Fed going to be cutting interest rates because of the inflation coming back to normal, but also because a U.S. economy boosted by deficit spending is also doing not so well anymore. Like I would say, this is the one big theme of this week. What do you think about this one? And maybe you see something even more important than that.
Yeah, so I mean, okay, from my side, the only thing I saw that kind of boosted the prospect of, say, the Fed cutting rates more than anticipated. Well, okay, anticipated is yeah, as you said, the market pricing is still, way overly dovish. I guess the the chance
They
of the
got
Fed
the
cutting.
finger, they want the whole hand.
Yeah, so the chance of the Fed cutting more than they're likely to project when we get the September dot plot in, I don't know, is it 2 or 3 weeks' time, is we had the consumer confidence data on Tuesday, which there's something in that subcomponent within the consumer confidence. It's called the, what was it? I think the people there's an index that measures the number of jobs availability or something like that. And that actually tracks very closely with the unemployment rate. And that index went up. So that kind of, gave hopes that, yes, maybe the Fed will cut rates aggressively after all. But pretty much everything else we got this week, we had very strong durable goods on Monday. We had yesterday
But
with the jobless claims.
I think the strength came from transportation. No, because I see core
Yeah,
durable
that
goods were
tends to
actually
be
flat.
volatile, but
Mhm.
nevertheless, basically what we're seeing from the headline numbers, at least, like nothing to worry about. We had weekly jobs claims yesterday, which were pretty much in line with expectations. US GDP in the second quarter was revised higher, and actually, the quarterly PCE price index, which comes along with the GDP report, that was slightly, I think, below expectations. Today it's a different picture. I think we're probably going to get the core PC price index probably rise in July, but on month, I think we headed towards that. The PC inflation kind of coming down towards the end of the year. So I don't think it's going to sort of, be a signal that inflation is rising again or anything like that. But yeah, overall, I think we're still kind of, the Fed and markets don't seem to be on the same page because the Fed is saying, yes, we are going to cut rates, but it's going to be, we're going to be cutting cautiously. We actually heard from Atlanta Fed President Raphael Bostic, who was probably one of the few hawkish ones who kind of still said that he still needs some convincing, to back a rate cut in September. But yeah, as you mentioned, Powell speaking in Jackson Hole on last Friday, which he probably was as dovish as he could have been realistically. And yeah, the euphoria was very short-lived. And then let's not forget, we had Nvidia earnings on Wednesday, which really was, maybe the biggest puzzle of all is that how can a giant company that already has, billions in revenue, they managed to more than double the revenue, and it's still not good enough for the market. So it's, I guess, that's more down to valuations being already so high, and specifically when it comes to AI, how much revenue is, AI going to generate in the future for all these tech companies. So I guess that's a whole different discussion. That's a whole different discussion compared to the Fed. But nevertheless, I think that was also a factor for kind of, keeping risk appetite in check this week. And yeah, I don't think today's data is going to really probably change much. I think it's all going to come to next week's jobs report. But clearly, when you've got market expectations, you know, uh, so far off from what the Fed is signaling, clearly, I think there could still be some volatility today.
Um, yeah, thank you, Rafi, and also I'm seeing Makantisa Chris is with us here in the chat. Guys, feel free to join the chat. Feel free to ask your questions, to actually drive this discussion towards more relevant areas for you. Feel free to share your ideas. Makantisa Chris is asking, Martin, do you trade news? Yes, sometimes I do. So if there is like piece of news is kind of like technical signal, in that sense for me, in that sense that when I'm seeing that it aligns in a way that chances are quite good for me, that I'm having confidence in how I can see market reaction whatever with whatever the outcome of the news is. Sometimes you feel like, okay, the outcome of the news is likely to be this or that, um, then I would be going for it. And when I'm having the idea that, okay, the market could react certain way after news being certain way, right? So it's mostly reactionary. Sometimes I'm going for certain trade before the news. Sometimes I'm going, so there are different ways how you can trade the news. Sometimes you are seeing the market is just overextended before the news, and you may trade the idea that the market going to moderate towards the news. Okay, so it's like a kind of a fade trade, but news is the timing. So last 2 or 3 days for before important release, it may be that the market going to be moderating excessive positioning, so the trade is actually before the news is happening with the impact of the expected release, but it happens before. And another trade could be that you get the outcome and you react to the outcome certain way that well, so first of all, you have this as a scenario that, for example, I can give you a good example. Yesterday's GDP, I was thinking that it gonna be. I was thinking that GDP may come actually worse and deepen the dollar sell-off, but if it came higher, that was like fairly clear that dollar may react positively to that because it's been oversold. This is what I also mentioned earlier, that market went from considering 3 rate cuts to considering 5 rate cuts, which is sort of like oversold dollar, right? Like market betting too much on the dollar weakness. So I was thinking that, okay, if it comes higher, um, that could be also surprise that would be clearly positive for the dollar. Sometimes it is that, oftentimes it is that you don't know, you don't have any idea what the number could be. And actually, for example, like forecasts are wrong 70% of the time. So we can be wrong 70% of the time too. That's not the problem. But sometimes you have this idea that, okay, if it comes certain way, I pretty much understand what the reaction should be, because sometimes it's that you don't know what the number will be, but you also don't know what the market reaction will be if the number comes this and that. Sometimes it's just the market is just totally in the woods, like or on the at the equilibrium point, in other words. So for that, I may not know what the number could be, and I may not know what the reaction could be. Like the market could be like anyways, but sometimes you see the market is stretched to one side. Like for example now, if another idea, if CPI, if PCE comes positive, I would say there is very good chance that the dollar gonna get stronger. And so first of all, we had slightly bullish dollar before because it was oversold, and now if it surprises to the upside, we're going to be having nice dollar rally most likely. And then um, another possibility, another idea is that you carry trade through the news, but this is like the most risky part because the volatility is you have one profile of volatility before, and you have another profile of volatility at the event and after. Okay, so it's kind of like carrying trade from before the news to past the news is exposing you to all sorts of volatile market behavior. So actually, the news, the trade that you make before the news and that you plan to carry through um, would have to be sort of prepared for high volatility, right? Or for adverse volatility scenarios. So for example, small size, big stop loss, right? The simplest way to put it, small size, big stop loss. But then you are seeing this volatility situation, which could be like favorable. And well, who makes um, trade for high volatility when the market is at low volatility, right? So that's the trick. So if you didn't plan to carry the trade, and you are in a situation that you have to do it, like for some reason, then probably you cut the size, you increase the stop loss. So it costs the same amount of money, but actually bigger market moves, bigger market noise doesn't affect, doesn't get you out of the position. And then when volatility normalizes after the event, you can of course go back into previous size, right? So this is not like so this is a kind of adjusting to volatility that could happen. Of course, not every news triggers the same volatility. Not every news has to trigger volatility. Like there's a chance that one event will trigger higher volatility, or more likely another event will is less likely to trigger less volatility. So it's not always the same. Of course, you can check it statistically, or you can essentially have it from your experience from watching certain amount of those events, how much they can move the market. So yeah, this is basically it. But most of my trades will be reactionary. Some will be before, um, some will be reactionary. Of course, if you trade long term, you don't care about single news, but then position is meant to be like for the bigger time horizon and with bigger stop loss by itself. So it kind of consumes those ranges, those short-term volatilities.